Okay, let's jump right in. Welcome to today's Explainer, where we're going to be looking at a true European powerhouse, Investor.AB. Now, if you track European equities, you already know the name. They're the financial engine of the legendary Wallenberg family, a family that, historically, controls roughly a third of Sweden's entire GDP. It's easily one of the most closely watched holding companies on the planet. And over the past year, they've been on an absolute tear, boasting this massive 39% stock rally. But whenever we see a surge like that, we really have to ask ourselves what's actually driving it. So today, we're going to unpack that rally, we'll run the numbers, and figure out exactly what is going on under the hood of this financial giant.
Here's our roadmap for this explainer. First, we'll look at the Q2 headline. Second, a two-speed portfolio. Third, the valuation conundrum. Fourth, we'll cover the macro headwinds. And finally, we'll break down the bull versus bear case.
All right, let's start with Section 1, the Q2 2026 headline. What's really catching everyone's eye here is this single, honestly staggering number 159%. In Q2 of 2026, Investor.AB reported a profit attributable to owners that jumped by a whopping 159% compared to the exact same period last year. To put some real-world weight on that percentage, we're talking about 117.3 billion Swedish kroner. That translates to roughly 11 billion euros in pure profit in just a single quarter. I mean, think about that sheer volume of cash for a second. It's a massive influx of capital, and it absolutely demands our attention.
So when we break down the core metrics, it's pretty obvious why investors were throwing a party. The adjusted net asset value, or NAV, climbed 9% to reach 1.215 trillion Swedish kronor, and yes, that includes dividends. Total shareholder return on the B share came in at a really robust 15%, which comfortably crushed the SIXRX benchmark return of 9%. On the surface, this looks like an absolute home run. But here's the secret to all this success. Almost all of this growth was driven by massive contributions from their listed assets. ABB alone added about 78 billion kronor to the NAV, riding these huge waves of demand in electrification and data center infrastructure. Meanwhile, Atlas Copco and Epiroc tossed in another 29 billion. Basically, their listed holdings are just completely on fire right now.
But this brings us to the central question of our explainer. We really need to ask, is this massive 39% rally actually justified? Or has the market just gotten a little bit ahead of itself? To answer that, we've got to pivot from celebrating the wins to doing some deeper investigative analysis.
Which brings us to Section 2, a two-speed portfolio.
We've got a classic two-speed dynamic happening here. It's literally a tale of two portfolios. On one hand, you have the surging listed portfolio, which is essentially pulling the entire train forward. But on the other hand, the unlisted, wholly owned portfolio is really struggling. Patricia Industries, which holds investors' wholly owned operating companies, actually declined by 3% due to multiple compression, and their investments in EQT fell 2%. So this forces us to stop and wonder, is Investor.AB operating as a uniformly high-quality holding company right now, or are they kind of just riding the coattails of a few oversized, wildly successful listed positions?
Let's peek under the hood at those wholly owned struggles. Patricia Industries' biggest holding is Mölnlycke, which is a wound care and surgical products company valued at roughly 75 billion kroner. In Q2, they managed a measly 2% organic growth, and if you look at the massive US market, their growth was essentially flat. Why? Well, hospitals are under intense budget pressure right now, meaning pricing power in these mature healthcare markets is rapidly eroding. Then you've got Atlas Antibodies, another holding, which actually declined 14% organically, alongside a really severe margin contraction of over 11 percentage points. The main takeaway for you here is that the wholly owned businesses, the ones management actually has direct operational control over, are representing a value preservation story right now, not a growth story.
Let's move on to Section 3, the valuation conundrum. To really make sense of the valuation, we first need to define the NAV discount, or net asset value discount. Historically, Investor.AB is traded at a substantial discount to its net asset value. This discount is basically the percentage by which the stock trades below the real, estimated value of all its underlying assets. For value investors, this discount is the ultimate safety margin. It compensates you for the weird holding company structure and the fact that some of these private assets are highly illiquid. But because of that massive 39% stock rally we've been talking about, this crucial margin of safety has shrunk significantly.
And you can see that anxiety reflecting directly in the analyst ratings. The current market price is hovering around 421 Swedish kronor,
but the consensus average rating for the B share is actually a moderate sell, sitting with a target price of 365 kroner. That implies a potential downside of roughly 13%. Now, opinions vary, for sure. Kepler Capital rates it a hold at 403 kroner, but Citi, they take a much more bearish stance, rating it a strict sell with a target of just 327 kroner. Clearly, fundamental analysts are looking at that compressed NAV discount, and they are feeling extremely cautious.
This sets up a really fascinating tug-of-war in the market. On one side, you have the fundamental view, the stock is simply overvalued, the NAV discount has compressed, and that traditional safety margin is practically erased. But on the flip side, you have the technical view. Technical analysts look at this chart and see completely intact momentum. They see a strong rising trend with a 3-month forecast predicting another 11% upside. That being said, even the technical folks note that the Relative Strength Index, or RSI, is flashing overbought, which usually signals a correction could be right around the corner. It's a classic Wall Street showdown between underlying fundamental value and pure market momentum.
All right, on to Section 4, navigating macroeconomic headwinds.
Look, Investor AB's underlying companies are world-class. Businesses like ABB, Atlas Copco, and SEB, these are not fragile entities. But management is very much reading the tea leaves of the global geopolitical environment. They've explicitly flagged a few major concerns: rising U.S.-China trade friction, ongoing conflict in the Middle East, this really stubborn inflation impacting input and freight costs, and the looming threat of supply chain disruptions. These are heavy macroeconomic headwinds, and they threaten to put serious pressure on both the high-flying listed companies and the struggling unlisted ones in their portfolio.
And this quote brilliantly illustrates how management plans to survive it. They state, "Navigating this environment requires differentiated products." Now that is some excellent corporate speak, but what it really translates to is a desperate need for exceptional pricing power. They need their products to be so uniquely crucial that customers are practically forced to pay up, regardless of all the macro uncertainty out there. As we saw earlier with Mölnlycke fighting for market share in the mature wound care space, finding that kind of pricing power is incredibly difficult right now.
Finally, Section 5, the bull versus bear case.
Honestly, both sides have a really solid argument here. The bull case points straight to the Wallenberg family's undeniable 100-year track record of execution and value creation. They're sitting on a highly conservative balance sheet with leverage at just 1.9 times EBITDA, and they have this beautifully diversified portfolio that has consistently beaten the Swedish market over the long haul. If you trust their capital allocation, you just buy the dip. But the bear case is making a ton of sense too. This 39% rally has absolutely outpaced the actual fundamentals. The private, wholly owned portfolio is severely lacking the organic growth you'd need to justify this kind of peak valuation. That traditional safety margin, the NAV discount, is historically thin right now. And structurally speaking, if those listed assets like ABB finally cool off, there is virtually no operational cushion coming from the private companies to break the fall. Basically, you're paying a premium price for a portfolio that might not deliver premium growth across the board.
Which brings us to our final takeaway. Investor AB remains a world-class institution, no doubt about it. But as we all know, even great companies can be terrible investments if you buy them at the wrong price. The risk-reward trade-off here simply isn't what it was 12 months ago. So the most practical thing you can do right now is this. Keep a very close eye on that NAV discount. Waiting for that discount to widen again might offer a much safer, much more logical entry point. So I'll leave you with this question to chew on. Do you trust the Wallenberg execution machine enough to pay a premium today and hold through a potential correction? Or will patience prove to be your ultimate margin of safety? Thanks for joining me for this explainer. Stay sharp and keep learning out there.